Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
I want to start with the Fed. And the Fed yesterday had their interest rate decision in which they held rates unchanged as expected, but they spoke of risks from unemployment as well as inflationary risks due to tariffs. So I'm curious about a couple things here. First of all, your take on tariffs. Are they inflationary, deflationary, or stagflationary? And secondly, what to make of this new Fed, if it is a new Fed mandate. It pretty much just means there's treading water, but whatever. The new Fed position, and then also maybe the employment market, the labor market in the U.S. So it's a whole bunch of stuff. I realize I threw at you right there. So start wherever you want, and we can take it from there.
Sounds good. So obviously the tariffs and the fear of tariffs, we view it as an inflationary fear. So basically what people are concerned about with the tariffs is the inflation going to go up. And inflation being high on its own, not great. But that's why we have Fed. So Fed has a dual mandate of keeping the inflation in check and targeting a certain employment rate, whatever they consider the full employment. And I think the fear of tariffs is that it creates an inflation that is a little bit of fake, in a sense. Like, I would say if there is such a thing as a natural inflation, let's say the economy is booming, the employment is super low, everybody's really bullish, the inflation goes high, that's when Fed steps in, increases rates, brings down the inflation, and in return, usually you would see Fed trying to bring down inflation raises unemployment. This inflation would be slightly different because, it wouldn't be due to the unemployment being super low and the economy booming. This would be kind of like an artificial inflation. And if it happens at the same time when the economy might be shrinking and the employment's going higher, that would tie Fed's hands, and Fed wouldn't be able to respond to the inflation. And that could create a real problem. So I think that's what the real fear is about. And that's why everybody was listening so carefully to every word at yesterday's press conference. And you saw the market just kind of, every sentence basically up and down, up and down, up and down. So I think people are really just waiting and trying to understand, what is Fed seeing as far as the real economy go? What is Fed seeing as far as unemployment goes, the GDP, and what are they going to do, if anything?
Yeah, and the Fed, they didn't actually speak to weakness in labor markets. They just spoke of risks to weakness in labor markets, which is an important distinction because the labor market data we've gotten is not really weak at all, is it?
No, not at all. I think, everybody who's tracking unemployment claims, payroll numbers, we've seen over and over, month over month, expectations exceeded, the numbers being in line with, kind of a steady economy, so not without fears, but there's nothing right now as far as the actual numbers that come out that would indicate that there is something immediate about to happen.
Is there anything else that you track that indicates that could be in the offing or not so much?
So we track, different measures of unemployment, changes on unemployment. We track a couple different inflations indicators. I think what's more interesting right now that could suggest some other things that I'm sure Fed is aware of because they track GDP and GDP forecasts is some of the manufacturing numbers and some of the business activity, shipping indicators, things of that nature. And that's also sort of being skewed by the tariffs because it's hard to distinguish between, people just being maybe more bearish on their orders versus shipments versus people stockpiling things in anticipation of tariffs. So like all the traditional macro indicators that usually paint a pretty clear picture are a little bit distorted right now.
Right. But you say distorted, which is an important distinction from there being a secular change, right? So it sounds like, I don't want to put words in your mouth, it sounds like you may view this as a temporary thing, the tariffs.
Personally, and this is not necessarily the view of the whole firm, but they could easily come and go as quickly as they came. So, one day we woke up to tariffs and there is no mandate that says like these tariffs have to stay for 4 years. So in theory, they could disappear tomorrow. And I think that's why we have seen like so much whiplash in the markets based on like every tweet that comes out because people realize how temporary these effects could be. So one, these are effects that are hard to measure the impact of, and two, these are effects that could be incredibly temporary. So this is a very challenging time for the investors and for financial advisors to like give any kind of advice to their clients.
Yeah, yeah. So what is an investor to do then in this? What markets do you trade and where do you potentially see opportunities?
So the core of our business is in the S&P 500. So the ETF we run basically make a decision every day about how invested you should be in the S&P 500. And we acquire this exposure through the SPY ETF, through E-mini futures, through SPX options, and cash instruments. And so basically we have been going in and out of the market. Like the longest exposure we have had this quarter has probably been about 150% long. We could go up to 200. And in theory, we could go short the market. That is extremely unlikely for us, but we have been as short as 70% invested. That is a short exposure for us. And so we have been active overall. We have been pretty close to 100% invested. So we are not saying run for the hills. We are saying periods of high volatility and periods of high uncertainty actually tend to produce excess returns for investors. So this is not a bad time to be in the market at all. So we do respond to changes in sentiment, volatility, prices, but we're not saying this is not the time to be invested in the market.
Oh, that's encouraging. Okay. Wow. Okay. So you would express that mainly through, I guess, buying calls on the S&P.
So we can. So the leverage is easy to acquire through the use of futures or through call options.
Very interesting. Okay. Cool. Petra Bakosova, I want to take a quick break and come back and ask you some more stuff about yourself, about your firm, about how you came to this stage of your career. And we're going to do all that after the break. If you are a premium subscriber, do not touch the dial. Don't go anywhere. You will not get a break. And everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show.
Welcome back here with Petra Bakosova. I believe I pronounced that correctly, from Slovakia, and currently based in Chicago. Petra, this is a segment of the show where we ask our guests to tell us a little bit more about themselves, how they came to this stage of their career, how they came to investing in the first place. And curious about your story. Tell us as much or as little as you like.
So I joined Whole Tactical in 2013, and prior to Whole Tactical, I was always based in Chicago. After I got my degree in financial mathematics, I started working for a couple different Chicago-based trading firms. I started as a quant, working on mostly research into futures market making strategies, as you would expect from Chicago trading firms. And then 2 companies later, I joined a company called Ketchum Trading, which was one of Blair's other firms. And then as soon as I joined, there was this, a little project in the corner of the firm called Whole Tactical, which was dedicated and was planning on launching an ETF. And sort of being the new kid on the block, I raised my hand to work on the strategies for Whole Tactical. And then next thing I know, this ETF got approved in December of 2014, and then we launched the fund in 2015, and we have been running an exchange-traded fund for the last 10 years.
Cool. And the HTUS is the ticker, it looks like, right? So 10-year anniversary. Congratulations. So what's the strategy? You touched on the first half, but basically trading S&P and SP options and futures, right?
Yeah, we can talk maybe first about the strategy itself, and sort of maybe then we can touch on the history of the firm. I think a lot of our investment philosophy would be explained by, where we came from and what our sort of overall vision and philosophy is when it comes to trading and investing. But so the strategy is meant to be centered around 100% long. So the central question we're trying to answer is, can you do better than just buy and hold by incorporating external information into your model? So we agree with the general premise that, U.S. equities have been a very important tool in everybody's investment portfolio. The equity risk premium, which is defined as the difference of return on equities minus the difference of risk-free, is on average positive and has been consistent for the last 50 years. And therefore, investors get compensated by, instead of putting their money into a risk-free asset, by having the money invested in the stock market. So that is all well and good, but we also think the equity risk premium is not constant. We think the equity risk premium varies over time, and we think it is a little bit predictable. We're not saying it's super easy to predict the equity risk premium, but we also don't subscribe to the philosophy that the buy and hold is the only way, and there is no information out there that could inform investors about, should you be more invested right now? Should you maybe step to the sidelines a little bit? So what we set out to do, every day we are collecting about 30 or 40 different indicators that have been described in academia as having some kind of predictive power. So these would be, broadly speaking, 4 different categories. We would track macro indicators. That would be, the inflation, unemployment, things of that nature. We track fundamental indicators. So we aggregate earnings, dividends, total yields, book values up to the index level, and we look at how they vary over time. We look at sentiment indicators, and this would be anything from market implied sentiment, tracked through some kind of VIX transformations. This would be, interest and activity in leverage inverse ETFs. These would be like sentiment surveys that go out to, different investors and allocators. And this would be basically even social media, news sentiment, any kind of sentiment. And the last category, I would say, is anything like technical, any kind of anomalies, seasonal anomalies, any kind of sort of things that there's not a good explanation about why they should work, except they do. So any kind of like momentum indicators, mean reversions, things of that nature. And then we call all of these little things, we call them micro alphas, because we think even though they all have a little bit of predictive power, they're not necessarily strong enough to predict the market in isolation. We don't think any of these is strong enough to work for every single year for 30 years. They come and go. Investors care about different things during different regimes. And so we built these sort of like machine learning models, which oftentimes would allow you to have a dynamic variable selection and place different weights on different indicators as the model goes through time. And then basically every day the model tries to predict next day's equity risk premium. And depending on if the model says, okay, we should be bullish, we should be bearish, then we increase or reduce our exposure to S&P 500.
Wow. Okay, that's really complex and really interesting. What can you tell me about the machine learning part? Like what kind of variables, what kind of inputs are there?
Yeah, so the inputs, so we start with what we just described, and then basically what we do, so the second step after we collect the data, we try to look for optimal transformation. So the next step of this like machine learning pipeline, if you will, is the feature engineering. And again, so we're looking at historically, what kind of transformations of these features have been predictive of the market in a robust way. So like one of the biggest fears and obstacles that money managers like us face is the potential of overfitting. If you torture data long enough, you will always find some kind
It'll
of
confess to anything, right?
Exactly. You can get it to tell you exactly what you want to hear.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
But then the question is, will it work once you move past the data sample that you have just been working on? So a lot of the feature engineering goes through a lot of different cross-validation steps when we try to optimize different features and transformations on different subsets of the data, see if they hold on the different subsets of the data, see if they hold when we roll them out to data that they've never seen before. And then hopefully once we found transformations that we consider robust, then we would do something like a elastic net regression, for example, which is a combination of a lasso and ridge regressions for those who want to go really into the detail, which allows you to shrink coefficients.
You've already lost me, but okay, go on, yeah.
So basically compared to a regular OLS, which people are very familiar with, you take, height and weight of somebody, and then you try to predict how good they are going to be at running or something like that. But again, the regular regressions, big potential for overfitting and big potential for overfitting for outliers in particular. And we do know that the financial market data is very noisy and it has a lot of outliers. So how do you fit, that's where sort of the machine learning inventions come handy, because it allows us to tackle the issues of not fitting to one bad data, not fitting to, overfitting to what happened during COVID. And so what we think it's really important is to have the ability to drop certain variables altogether during different periods of time and or shrink their impact. And so these regularized regressions allow us to do exactly that.
And these micro alphas that you mentioned, you touched on it before, they are all pointing to risk premium being advantageous. So
the interesting thing is they never agree. So one thing that we do, and this is
that true in history? If you went back to September 2008, were they?
Yes. So, and one thing we do, aside from, we published a number of our models in peer-reviewed journals. So we are very transparent about what we do. And we also publish a daily report, and we put it on our website for everybody to see for free. And we sort of break down these micro alphas into broader categories. And we show, which of them have bullish impact on our signal, bearish impact. And I don't think I have ever seen a day in the 10 years of history where everything was pointing in one direction. So most of the time you will see some disagreement. So the valuations are almost always bearish. Like, the market, like ever since I remember, if you were looking at the price to earnings ratios, almost always it would tell you the market's overvalued. And the sentiment can be, bullish and bearish. A lot of times when things are going really well, the sentiment would be really bullish, but then you would get some, negative signals from technical indicators or from valuations. And a lot of times people are still really scared after some turbulent period. The sentiment would be very bearish, but you see the macro variables looking really strong and looking really good. So there's almost never an agreement from every indicator that we have. And I think it's something that the advisors we work with find very useful when they talk to their clients as well, because I think especially this year, they have spent a lot of time just talking their clients off the ledge, and they can kind of show them like, okay, this is not all, black and white. Like there's always some shades of, there's always good news and bad news in the market, and you can't get too fixated of just like one indicator and one number.
All right, so the founder of your firm has a background, well, I don't want to say he has a background, but part of the inspiration, I guess I should say, for this strategy came from playing blackjack in the casino. Is that right?
Yes. So before whole tactical and before catch-up trading, and even before whole trading, which is the company Blair is most famous for, not everybody knows that Blair started his career in investing at a blackjack table. He actually refers to his blackjack experience as his first investment experience, and he was part of those card counting teams. I know a lot of people have seen or read 21, and that is basically how he got started. So for about 5 years, he would spend every weekend in a casino in Vegas counting cards. And what a lot of people may not appreciate from the books or from the movies is just how laborious of a process this is. This is not just some like, you walk in and make $1 million bet and walk out a rich person. This is basically accumulating very small edges over just thousands of hands. I think over his career, he estimates he played about 200,000 hands of blackjack. So, there's definitely parallels between what we do now and how this all started. So basically, as they card counts, they try to estimate, the rest of the deck. Is it a hot deck or a cold deck? And that's kind of what we do when we accumulate these micro alphas. We're trying to, estimate, like, is the equity risk premium going forward high or low? And based on what we have just seen play out in the history, we're trying to make bets on the future. And another parallel between blackjack is they always bet proportional to the advantage. So as the deck was getting hotter and hotter, they made bigger and bigger bets. And that's exactly what we do. Like when we see more and more of our indicators agree on the direction of the market, then we start placing larger and larger bets. So our bets are also not uniform. And then I guess the last piece that kind of transcended all the trading firms and including us is the importance of staying in the game. So, always, if you have to, cut your losses, if you have to do any kind of risk management procedures, have a risk management plan in hand and stick with it. So like staying in the game is, more important than anything else.
So hang on. So you can get a hot deck in blackjack? Is that kind of magical thinking?
Not anymore. So the casinos wised up over the time. So when they first started, I believe they would play blackjack with like 4 decks. So if you paid enough attention and you counted long enough, you could count how many of the high value, low value cards have been played, and see what's left. But then they kind of figured out if they start adding more and more decks to the game, it becomes harder and harder to get any kind of advantage.
So how many decks do they play with now? Do they add them incrementally? Like,
I think it depends on the game. It's at least 6 or 8 or up to like infinity.
interesting. Wow, that's so interesting. Okay. Petra Bakosova, maybe in closing, you tell our listeners how they can find out more about you, more about the firm, whether you're on the socials, and I'll put that all in the show notes as well.
Absolutely, that would be great. So as I mentioned, one of the things we do that I think is really cool is we are very transparent about our research. So to us, we love managing this ETF and we love it as an investment product, but we also, our secondary interest in doing this is contributing to the academic discourse about whether or not you can beat buy and hold. So as I mentioned, we published most of our research already, or we're in the process of publishing it. And then we publish our daily report. So if you just want to track our signal without investing in the ETF, that's also an option. You are more than welcome to use our signals to trade yourself. And then if you want to find out these reports or signals, we have 2 websites. One is www.holdtactical.com, which is our advisory website. If you want to read more about the fund, it's www.holdtacticalfunds.com. And we are also on socials. We try to be active on LinkedIn and X, and you can meet us at different conferences. There's also a contact form on the website. So if you want to hear more about any of this, just reach out and we will be happy to talk to anyone.
Very cool. Awesome. HoldTactical.com, HoldTacticalFunds.com. Put that in the show notes. And thank you to Petra. Thank you all for listening. We will be back here again in a week or 2. Look forward to speaking then.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.